Hello friends, welcome to our webinar. We're going to get started in just a few minutes. We're going to be focusing today on risk management using options when you're trading with the AvaOptions WebTrader or the AvaOptions mobile app or the AvaOptions desktop trader. But all of our work today will be using the new WebTrader, which just went live about 2 months ago and is proving to be very popular. We're quite proud of it. So we're going to give people a few minutes to sign in. We have, I think, a record number of attendees scheduled for today's presentation. So we're going to give people 3 minutes until 3 minutes past the hour before I actually get started with the presentation. In the meantime, feel free to type in questions and I will do my best to answer them throughout the presentation. So just give us a few minutes. We'll give people a chance to sign in, just a few more minutes. 3 minutes past the hour, we'll get started. Thank you. Hello, everyone. We're going to get started in just a few minutes. We have quite a few people registered for today's webinar. So we're just going to give people until 3 minutes past the hour to log in and get themselves set up. And we're going to focus today on risk management, how to use options to manage risk, how to understand risk using the risk management screens that are found in both the new AvaOptions WebTrader as well as in the mobile app. And you can also find similar tools in our legacy desktop Windows platform. So just another 2 minutes before we get started. Feel free to type any questions, ask any questions in either chat or in the whatever menu you're offered to ask questions, and I'll be sure to answer them along the way. And here's our very first question. What makes a trader hold on to a losing trade more than a winning trade? So this is a psychology question from Themba. Thank you for the question. Why do retail traders in particular hold on to losers and quickly take profits on winners? This is a very common error made by traders, and not just retail traders. I would just say any position that you have on, don't think about whether it's making money or losing money. Ask yourself the question, if I did not have this trade on right now, would I put it on? This is the right way to approach any position, whether it's open or not open. If I did not have this position, would I hold on to it? Would I put it on? Just cover that. So it's a real curse, I think, of psychology that retail traders often fall victim to, which is if they're losing money, they hold on and hold on and hold on, saying, oh, it'll come back. It'll come back. And taking a loss on a trade that's not working requires some experience, perhaps some maturity or some understanding that just because it's losing doesn't mean it's going to come back. Just because a trade is winning doesn't mean it's going to give up its profits. Ask yourself every time, do I like this position? If I didn't have this position on, would I hold on to it? Now, let me get started by saying it's now 3 minutes past the hour, so we're going to get started. My name is Steven Reiter. I am responsible for the options business at AvaTrade. My team built the WebTrader and the mobile apps that we're going to be seeing today. And we're going to focus today's discussion on risk management using the unique tools of our WebTrader and mobile app. I should start by saying anything you hear me say today should not be taken as trading advice. We're not offering recommendations on what to trade, whether you should buy or should sell, whether something's going up or down. We want to teach you the tools of the trade and what's available to you for trading in our platforms. Now, AvaTrade offers a number of platforms, MT4 and MT5, the WebTrader, which can be based on either an MT4 or MT5 account, and AvaOptions, and also some copy trading technologies and other things like AvaSocial. AvaOptions is where you come to trade options. And using options, you can establish risk, reduce risk, and do all sorts of things that you could not do otherwise when you're just trading in a platform like MT4 or MT5, where you can only buy or sell. Everyone can hear me, it looks like. Somebody's been trading crude oil since November 2020, when the pandemic is over. Is it that when there are more supply or more production, or the price is going back down? The price of every asset depends on supply and demand. It's that simple. Supply and demand drives the price of anything. Options, the market sets the price. So it's all a question of supply and demand. The price of oil is interesting because it's very difficult, or there's a limited way to store oil. So if you want to buy oil today because you think we're coming out of the pandemic and therefore the price of oil is going to go higher, that's great. The problem is you need a place to store that oil. So the price of oil today can be very different than the price of oil for delivery a year from now. You have to keep that in mind when you're trading oil. Okay, I'm going to switch our view to our new WebTrader. That's gonna be over here. Okay, welcome to the WebTrader. I'm actually going to, should I hide myself? I guess I can leave my photo up there and you can decide to close it if you want. If somebody thinks that I should close my webcam so you can't see me, you can certainly let me know. This is our WebTrader. Now, our WebTrader looks like a lot of other trading platforms. I'm just going to pull up here Eurodollar. This is the normal trading platform. When somebody is looking at a trading platform, let's look at a 15-minute chart. Here's a 15-minute chart for Eurodollar. This is trading spot. And by spot, I mean you're just buying foreign exchange. You're buying Eurodollar just like you would on any other trading platform, MT4, MT5, AvaWebTrader, or AvaOptions. Our platform is unique in that it's showing us this profit and loss diagram on the right side. Here you can see that if I'm buying Eurodollar, if the market goes higher, I'm going to make money. This is showing me my profits in price terms. So if spot goes from 121.27, if it goes up to 121.48, I'm going to be making roughly 20 pips, 0.002. I can see my profit in euros or in dollars or in price terms. So this is a euro-based account, but I can see my profit in dollars since the quote term is dollars. It's euro dollar, so the price is usually quoted in dollars. If I buy at 121.25, if I buy 100,000 at 121.25 and we go up to 121.45, I'm going to make $200 profit. You can see that right on the chart. If the market goes down, I'm going to lose. If I go short the market, I just have to click sell. And now you see that we're going to profit when the market goes down, and we'll lose money if the market goes up. This is no different than trading FX on any other trading platform. The unique thing we have here is this profit and loss diagram. And you're going to understand why in a moment, and then we'll talk about risk management. Let's say I want to put a limit order. I click the word limit on the side of the page, and I can put in a take profit. I can click on this take profit line, and let's say I want to sell. I want to take a profit at 121.50, like that. And I can put in a stop loss. I think I'm going to put in a stop loss right along this dip that we had in the market last week. I'm going to put in a stop loss at 121.31. Sorry, that's 121.13. So you can see in this picture very clearly what's going on. I'm going to buy Eurodollar. If the market goes up, I can profit up until I hit my take profit. I'll be taken out of the trade at 121.50, where I'll make a profit of $259. If, on the other hand, the market goes down and I hit my stop loss, I'll be losing $110. Stop losses are not guaranteed, so if the market blasts through that level, you could lose a bit more, but of course, Eurodollar is super liquid. That is the a unique feature of our platform. It's just very visual. You can't mess it up. If I take this stop loss and I move it around, we can see how much money I can make or lose, and I can try different levels. And I say, you know what, I'm gonna put in a stop loss closer to this support level that we saw a few days ago. Or I can push this limit all the way up here. And of course, I can only have one take profit level. So it knocks out my previous profit level. I'll do that again. Okay. So this is a kind of a neat platform. And if I go short the market, then my take profit is down below and my stop loss is up above. If I like this trade, I click sell. It shows me how much margin I'm going to need for this transaction. It shows me exactly the trade, the order that I'm leaving. I'm leaving an order to sell 100,000 euro dollar. Sorry, I'm going to sell at market 100,000 euro dollar, and I've got a take profit and a stop loss. I click execute. And the trade will show there it's done. And you can see it down at the bottom of the page. Just sort it. You can see that what we've done, we've sold cash. It looks like the order is going to get sorted in a second. I've sold Eurodollar, and I have in blue a take profit and a stop loss because those are pending orders on my open position. So that's just a quick picture of how spot trading works. And the reason that we have this is because we like to trade options. Now, let's say you want to trade an option like a call option. I'm still on Eurodollar. I just click the word spot and I choose a call. A call option gives you the right to buy, but not the obligation to buy an asset at a specific price. So I have here a 1 week option. You see the expiration date is 1 week. I can change it to 2 weeks. I can choose any date I like. It's a 2 week option. I have the right to buy at 121.30. It's going to cost me 50 pips, 0.005. If I click this white box, I can see how much it'll cost me in dollars. 50 pips on 100,000 is $500. I can also see it in, I should be able to see this in euros. I don't know why I don't in this screen. That looks like a bug. So I can buy this option in dollars. I don't see it in euros here because the exchange rate is moving around. I can see it in my profit and loss diagram. If I buy this option for $500, the most I can lose is $500 because I'm buying an option. If it finishes out of the money, I lose $500. I can see it in euros, my P&L in euros. That would be losing 400 euros because I'm going to buy this upfront. Exchange rate is 120, $500, 400 euros. I can change my strike price. And as I change my strike price, you see the price of the option changes. So an option to buy at 122.60 only costs $135, whereas an at the money option costs $545. So an out of the money option, like buying insurance on your car with a deductible, costs less. You don't start to get paid out until the market has moved further. If I buy an option that's in the money, you can see it's going to cost a lot more. Very simple. The orange line that you see here is telling us our profit and loss today as the market moves up and down. The red and green lines are showing us our profit and loss at expiration. So if I buy an option today, we're going to be right here at the current spot level. At the current spot level, you can see the orange line is close to zero. I'm only going to be suffering a bid-ask spread to buy this option right now. If the market moves higher, I start to profit. If the market goes lower, I start to lose. And over time, this orange line will approach the expiration P&L, which is in red and green. And I'm sorry I'm going a little bit quickly because I want to get to the risk management section. If you go to the AvaOptions YouTube channel, you'll find all sorts of excellent videos and webinars explaining all these concepts from beginner levels to advanced levels to learn about options. If I change this horizon line at the top, the horizon line says that this orange line is now. It's showing us the P&L as the market moves up and down right now. If I change my horizon line, you can see after 10 days, the value of the option is decaying and it starts to approach the red and the green expiration P&L like that. So today, the profit and loss looks like this. At expiration, it's going to look like that. And you can play with this on any option strategy. I'm not going to change that right now. I'm not going to execute this right now. Let me just show you one other option strategy. We have many option strategies. If you don't know what they are, click here to get a guide. And you can ask, what is a strangle? Oh, a strangle lets you gain exposure. If you buy a strangle, you're gaining exposure to big market moves by buying a call and buying a put. What does selling a strangle look like? Looks like that. I can flip through and look at all the strategies until I see one that fits my market view and then decide how I want to trade it. So let's say I'm going to do a put spread. I click try it. This is buying a put spread. When you buy a put spread, you're buying one put, a high strike put, and you're selling a low strike put. You can also sell a put spread. If you sell a put spread, you're going to get an upfront credit. You're going to earn cash into your account upfront, but of course that has to be posted. You can't really do anything with that cash because on a mark-to-market basis, you're not making any money yet, not until expiration. So when I sell a put spread, it means I'm buying a put that's out of the money, I'm selling a put that's in the money, and I can change the strikes and look at the red versus green areas. You see how, as I'm moving things, you see a trade-off between risk and reward. Here I'm taking more risk. I can lose more money because I can lose up to $1,600 euros, whereas my maximum profit is only 800. But I'm going to get to that maximum profit sooner because the strike is closer to the money. So as I move my strikes, all of the numbers update automatically. Here in the center, we have what's called our confidence range. This center arc with the two white dots at the end is showing us plus and minus 2 standard deviations of movement over the 2-week period of this option. So it's framing the risk of the trade. It's not just showing numbers without context. We're showing you where has the market been for the last 2 weeks, where might it go in the next 2 weeks, and how will your position or how will your trade perform in that period and in between. So you can see today and expiration. Very easy to use. I hope it's very easy to understand. As we change the expiration date, you'll see that this confidence range is going to get updated. If we do a longer option, the market can move much more. So you see that the range grows. If I do a shorter option, the market has less opportunity to move, all the way down to a 1-day option or an overnight option. So that is the trading platform in a nutshell. I'm not going to place this option trade yet because I want to focus on risk management. Bastian is asking if we have trailing stops. We do not have trailing stops in this platform, but we do have some other advantages, which I'll show you. For example, we can leave partial limit orders. So we have a position in 100,000 in our open positions down below, and we have limit orders on the full amount, but we don't have to. We can have a limit order on 50,000 at one price and another 50,000 at another price. So we don't have trailing stops. We have other types of orders. I'm going to cancel these 2 limit orders. I just chose them down at the bottom and I canceled them. They're going to disappear because I want to keep this very clean. So let's look at risk management. At the bottom of the page, you see open positions and pending orders. The only thing that we did was we sold cash. We sold spot FX in 100,000. We sold it at 121.23. We're still trading right around there, so we have a €5 mark-to-market loss. If I click on the risk manager, it's showing us our risk by currency. So we're short euro dollar, which means we're short euros and we're long dollars, because every foreign exchange trade, every currency pair trade, when you buy euro dollar, you're buying euros against the dollar. If I'm selling euro dollar, it means I'm selling euros against the dollar, which means that I'm short euros and long dollars. So this risk management bar chart is showing you that we are short euros in 100,000 euros, down at the bottom, 100, and I'm long 100 euros worth of dollars. This is a euro account, so it's showing me all my numbers in euros. By currency pair, I only have one position. I'm short euro dollar in 100,000. let's put on another position. Let's put on a cable position. Cable is the pound against the dollar. Let's just look at a 15-minute chart here. By the way, I can put in things like moving averages, and we have all sorts of studies. Your favorite RSI and other things are here. We've got a fairly robust platform for you. So let's put on another trade. I'll go back here to open positions. I sold euro dollar. Now I'm going to buy 50,000, just 50,000 of the pound against the dollar. Click buy. It requires another 500 euros of margin. Execute. Done. There it is at the bottom of the page. So now I've gone long the pound against the dollar and short euros against the dollar. Let's break those trades down. I'm long 100,000 euros against 100,000 euros worth of the dollar. Sorry, I'm short euros against the dollar, and I'm long 50,000 euros, 50,000 pounds against 50,000 pounds worth of the dollar. Put those two together, and what does it mean? It means I'm still short the euro. That's the only thing that I'm short. And against that, I'm now long a combination of the pound and the dollar. So it's netting our trade. It's netting our risk. If we just make this a little bit larger, we can see the two trades that we have on. We're short euro dollar, we're long the pound. Break those down. Here's the positions. I'm short euro dollar, I'm long the pound against the dollar. Break it down to the constituent parts, and you can see that we're short euros and long the pound and the dollar. So I'm sorry I'm going quickly and if I'm getting over your head, but I really want to show you how to use this platform to understand your risk. Because we put on two trades here and you really need to understand, and these pictures are showing you that I'm only short the euro now, and I'm long the pound and the dollar. You don't have to think of this as simply euro dollar and pound against the dollar, which is also called cable. Now let's close these trades. Just going to come right back here. I'm going to take this position. When I choose the pound here, when I choose a position, it populates it up front, up top. And it's showing me that I'm just have a tiny loss right now. I'm going to close that trade. That's done. And now let's close this one as well. Whoops. Close this one as well. I have to close that. Click this, execute. That's also closed. Okay, now we're back. We have no positions. That'll disappear in a second. And we have here, where are we? Didn't I close that? Execute. Yep, it's already closed. Just hasn't updated yet in the platform. Give it a second. This is the stuff I have to remove from the recording before we publish it. Okay, while that's catching up, I'm going to come here. There you go, it's gone now. Let's go back to euro dollar and let's trade an option. I'm going to simply buy 500,000 calls for a month. I'm just going to do them right at the money. I'm going to buy this call at the money. It's going to cost me $3,977. I'm going to click buy. Here's the, in euros, it's going to cost me 3,283 euros. Execute. Okay, that trade is done. And now it's down at the bottom. So what does my risk look like? I choose it. My risk looks like this. I'm long a call. As the market goes higher, I'm going to make a whole bunch of money. If the market goes lower, I'm going to start to lose, but the most I can lose is what I paid for the option. Put it back into, let's say, euros. The most I can lose is what I paid for the option. Okay. Someone asked, if I'm long the pound against the dollar, aren't you also shorting the dollar? That's right. We bought the pound, but we only bought, in that example a minute ago, we only bought 50,000 pounds, which means we're long 50,000 pounds, and we were short around $70,000. Prior to that, we were long 100,000 euros worth of the dollar. So we were long more dollars than we were short, which is why we were net long dollars, net long pounds, and short euros. Now back to this picture. We have risk. We have asymmetric risk, which is the beauty of options, of course. We're long a call, which means we have unlimited profit potential. And the most we can lose is what we paid for the option. But suppose we want to balance this risk. I no longer have the view that the market is going to go up. It might go up, but I think there's also a chance it's going to go down. So how do I change my exposure? Well, one thing I can do, of course, is to simply close the position. But another thing that I can do is to hedge the position so that I don't have a directional bias anymore. And let me show you what I mean. If I go to the risk manager is telling us that we are long a call in 500,000 euros, which is the equivalent of being long 260,000 euros, because the option has a delta of 50%. You see here the slope of the orange line is 50%. This option has a delta of 50%. For every 10 pips that euro dollar moves higher, this option will profit 5 pips. And for every 10 pips that the market goes down from here, the option will drop 5 pips. The slope of this orange line, which is known as the delta, is 50% because it's an at-the-money option. If I want to hedge this thing, then it says that my net exposure is equivalent to being long 259,000 euros. If I therefore sell 260,000 euros, I'm going to be hedged. Let's do it, and you'll see. I'm going to clear this out. I'm going to go to Eurodollar, trade spot, and I'm going to sell 260,000 euros. Click here, execute. Trade is done. You're going to see it down here in a moment. So we have 2 trades. We're long a call, and we're now short cash. And if I look here right at the total delta column, I'm long 260,000 from the option, which we can see in this picture. If I also look at the spot position, I'm short. So I'm long one, short one. Put them together, I've created a straddle. I've created the exposure of a straddle. Look here in the risk manager, my net risk is almost nothing. That's my total delta by currency pair. Oh, that's not right. It hasn't, it looks like it's not updated yet or some other issue. So again, I choose these 2 positions. I've now created a position where I'm hedged. I no longer have a bias up or down. If the market goes up, my 500,000 euros of a call are going to profit, but my spot position is going to start to lose. If the market goes down, my option is going to start to lose, but my short position is going to profit. So what I've created by a combination of a call and half of the short position is I've created the same exposure as you would have with a straddle. And over time, as the option decays, I'm going to end up with this P&L that matches the expiration, matches the expiration line. Okay, so there are other ways that we could hedge this position. Let's get rid of this cash position. Let's just close out the cash position by choosing it. All right, close out the cash position by choosing it. Just see one thing. Execute. I'm now closed out the cash position. We're back to having only the call option. That'll update in a moment. By the way, here in the history tab, you can see all the trades that we've done today. In the closed trades, you can see the trades that we've done today. We're just waiting for this last execution to show up. Some sort of a delay in the system, maybe because, well, I don't know why, that's not good. So we've got, there it is. So now we're back down to 1 position. We're back to our call. If I go to the risk manager, the only position we have is the call option. We're back to our delta being long 500,000, long 250,000 equivalent of exposure. That's our, back to where we started. So let's say there's something else I wanted to do. I've spent a whole bunch of money, let's put it in euros. I've spent 3,200 euros on this option, and I'm still bullish, but I don't know how far the market's going to go higher. let me sell some of my upside in order to earn some of that premium back, right? I bought a call option, but let's cap it. Let's sell a call up here and try to earn some of that income back. So I've long a call on 500,000. I spent 3,200 euros on it. Let's put on another trade. I unselect that. I'm going to go now to sell a call for the same expiration date, which is 2 weeks. Let's choose a 2-week option. I'm going to sell a call option. If I sell a call up here, let's see, was that 2 weeks? The expiration date was the 15th of March. It was a 1-month option. Okay, let's sell a call. I bought a call at with a strike of 121.25. Let's sell a 122.50 call. If I sell a 122.50 call, I'm going to get back 600 euros of premium. Oh, sorry, that's wrong. I've got the wrong size. I want to do 500,000. Knew that number looked low. So if I sell that, I'm going to get another 1,100. I'm going to get 1/3 of my premium back. Let's click it, execute. That trade is done. This time it came in nice and quickly. So now we have a call spread. We're long a call at 121.25 and we've sold a call at 122.50. Let's put them together. There's the call I bought, and now let's add in the call that I sold. Voila, this is a call spread. So what have we done? We've reduced the most we can lose because we earned premium back on the second option. And we still have plenty of profit potential, but we've limited it because I'm going to start to profit from the low strike, the one we bought, and our maximum profit at expiration is going to happen anywhere from 122.50 and higher. So I've created a call spread. And over time, again, that orange line approaches the expiration line. Someone has asked me about the straddle that we created. Anytime you have a straddle or the exposure that we created with a combination of a call option and the underlying asset, anytime you do that, you make money when the market has a big move. I'm going to, let's just clear this out. Let me show you a straddle on Eurodollar. Here is a straddle. Buying a straddle. To make money in a straddle, the market has to have a good size move because you're paying up front for 2 options. You're paying so that the market you can profit if the market has a big move higher or the market has a big move lower. Or you can profit today if the market goes nuts and implied volatility moves higher. But that's not really going to happen without the market moving. So you're spending a lot of money when you buy a straddle. You're buying 2 options. We actually like selling straddles more because when you sell a straddle, you're getting paid for 2 options. But you're only going to lose on one side. Either the market's going to go higher or it's going to go lower, or even more than a straddle, a strangle is a great strategy to consider. This is a 1-month strangle. So I'm selling both. Let's sell a 122.50 call and a 120 put. Let's even get a little tighter. Let's look at where the market has been for the last month, which is in the chart. And let's put our strikes right around that range. If you think the market is going to stay in that range, you can earn, how many pips is this? You're going to earn 56 pips for the next month by being correct. If the market stays in that range, you're going to earn 56 pips. Your break even is going to be the high strike plus 56 pips. And the break even on the downside will be the low strike plus 56 pips. So over time, you're going to earn income. You're earning theta. Selling options, you're the insurance company. You're taking risk and you're getting paid for it. Ali is asking if options trading is only for one currency. We offer options on all of these currencies, 42 currencies. So I can give you examples, of course, in anything you like. For example, Aussie yen. You want to do options on Aussie yen? No problem. The account is in euros in this example, but your account can be opened in pounds sterling, euros, dollars, Swiss francs, Aussie dollars, and a few others. Someone's asking if we have the ASX index. We do. The ASX index is also called, that's the Australian Stock Exchange, it's also called the SPI 200. Now, in the equity indices right now, we offer trading in the indices. We are soon going to launch options on the indices. For now, we only offer options on gold, silver, and currencies, but very soon we're going to have options on indices as well. And then we'll add options on other things. We're very hard at work on that. Okay, great. So let's look again at the trade that we did, the trades that we have on. We sold a call and we bought a call. Let's look at our risk manager. Our risk manager is saying that we have the equivalent of, even though these are two options on $500,000, our net risk is the equivalent of 123,000 right now. That's the slope of this orange line based on the combination of trades. Looks like it's about 25%. 25% of $500,000 is 125,000 of net risk. As the market moves higher, the delta increases until, it increases initially and then it falls off to zero, because once you're out of the position, once we've gone well past the high strike, we have no more exposure, and down on the downside as well. And if we look at the individual positions, there's our total delta. We only have euro dollar is the only thing that we have on. Now, I'd like to actually show you another account that we have. This is a real portfolio from someone that works with us very closely. These are real trades that are put on by someone. I'm going to show it here. There we go. This is another portfolio. I've switched to another account. And what you can see in the open positions is that this portfolio is short everything. It sold calls and it sold puts on Swiss yen, on Euro sterling, on Euro Aussie, on Euro CAD, on CAD Swiss, on Aussie Kiwi. It sold options on a whole bunch of everything. The trades were done over the last few weeks. You see the trade dates are from January 19th through January 26th, and the expirations are all also coming up, 11th of March and the 18th of March. Let's look at the risk manager. The risk manager is showing net exposure, as we said, by currency, but the table underneath shows by currency pair. That this account is short options in a whole bunch of currency pairs. We've got 8 currency pairs. And look at the P&L column, the unrealized profit and loss column. These trades were put on over the last few weeks, and they're starting to earn money because the customer has sold straddles. Time is going by, the market is not moving, and the customer is earning income, earning that theta in 6 out of the 8 pairs. In 2 pairs, he's losing money so far. In Swiss yen and Euro sterling, he's losing money because those markets must have moved further. But in the pairs that the other pairs, in 6 out of the 8 pairs, he's making money. So what this customer has done, this trader has done, is he's diversified his risk. He's sold volatility. He's sold options on 8 currency pairs and made sure that his risk is distributed. Look at the nice bar charts. No currency is dominating his risk. He's got a nice balance across 8 currencies in 8 currency pairs. So he's really balancing his risk and understands how to trade. He's taking risk, but it's not unbalanced risk. He knows what he's doing. He's focused on what he's doing. He's got a real option strategy. That's not to say that anything is guaranteed. As the market moves, as you can see, in 2 of these pairs, he is losing money. But if I click here at total vega, that's the customer's exposure to a change in implied volatilities. He's only short options, but they're diversified. There's his delta by currency pair. Some he's long, some he's short, but his total delta by currency, nice and balanced. Let's look at a couple of positions. Let's go back here to the open positions. He's making money in, let's start with where he's making money. Let's look at something simple like EuroCAD. Let's look at the EuroCAD positions. We're going to end this webinar within 10 minutes, by the way, but it will be recorded. So I said EuroCAD. Let's choose his 2 EuroCAD positions. Sold a call and he sold a put. Just to make this easier to see, I'll expand this back down. I'm going to expand this. So you can see, I'm just going to zoom out here. You can see here when he put the trade on. He put the trade on, these were at the money, when spot was trading at around 154 in EuroCAD. He sold, it says put, unfortunately right now, there's a call underneath it. You just can't see it. That's something we need to fix. If I hide the put, you'll see there's the call. He sold a call and he sold a put. They're both right there. So you can see that he's got a straddle. But as time is passing, he's making money. The market hasn't moved very much. We're not at the peak point of profitability. The peak of profitability would be for the market to stay right here at the strike. But we're still in this green zone and we're making money. So as of today, these positions are making a net 73 euros. But if we make it all the way to expiration, then these positions, if we're staying right here, are going to make something like 300 euros. Looks great. Now let's choose different pairs. Let's look instead at something that wasn't working. And we saw that the account is losing money in euro sterling. Not a lot. Let's have a look. Open positions. Let's choose the euro sterling positions. Sold a call. Well, sorry, sold a call. That's working because the call strike is much higher at 0.8875. We're trading 50 pips lower than that. But the put is not making money. The put is losing money because the put is now in the money. We're below the strike of the put. Put these two trades together and you can see that this is a straddle. I can make this a little bit bigger. I can even close that so you can see it a bit bigger. So net, we're getting towards the edge here. We're losing money right now because on a mark-to-market basis, you see we're on this orange line. We're losing net 40 euros or something like that. But if the market, even if the market stays here and we get to expiration, it should move into profitability because the break even on this trade is the strikes minus, the break even on the downside is the strikes minus the premium earned. And the premium earned was 83 pips on the put and 89 pips on the call, 0.0089 plus 0.0084 is 173 pips, 173 pips below the strike of 0.8875 gives us a break even of 0.87. So his break even is right down here at 0.87, which we're still higher than 0.87. So if you finish here, it's still going to be profitable. Pretty cool. So options give you control over your risk. The only risk management tool that you have when trading spot is a stop loss and a take profit. That's the only thing. Okay, trailing stops in some other platforms, but it's still at the end of the day, a trailing stop is also a take profit or a stop loss. When you're trading only with FX or only with an asset, it's buy or sell. That's it. You want to get more control? Use options. Take control of your risk. Put on asymmetric risk, or even, as in the example of this portfolio, establish risk. If your view is the market's not going to move, there's no way to make money when trading without options. If you think the market's going to stay right here, there's nothing to do. But with options, you can say, oh, I'll sell a strangle. If you say, I'm not sure if the market's going to go up, but I know it's not going down and I'm comfortable that it's not going down, sell a put. Get paid for your view, which you have no way to profit from without using options. This platform, of course, as I've shown you, is excellent for trading FX and indices, but of course for options is where it really shines. Almost all of the customers using, all of the accounts using this platform are trading options, of course. But you can trade spot, you can trade gold really nicely. We've got all the historical data you want. We've got nice charting tools if you want to put on here an RSI. Let's use the normal colors, but let's put an RSI. You can put in your Fibonacci stuff and stochastics and Bollinger Bands and a lot of the technical studies that you know and love. And then you can put that on top of an option strategy and really decide, hey, what's going to work for me? Let's do a 2-month option and ask yourself, what trade do you want to put on and how's that going to work for you? Okay, so let me just have a quick look at some of the questions we had. Someone's asking about multiple charts. You can have multiple studies on the same screen. We will, in the near future, let you create multiple charts and break them out across all of your desk real estate if you have multiple screens. Someone asks, what would you say to the saying, selling options is like picking pennies from a railroad track? I don't agree with that. Options are risky. When you sell an option, you're taking risk. Oh, is it like picking pennies from a railroad track that the train could run over your fingers, I guess? Well, I suppose, but it's not pennies. You decide how much risk you want to take. You can take a lot of risk, you can take a little risk. Often people say options are risky. I don't want to trade options, they're too risky. Options are not more risky than trading spot. If you're trading regular FX or an asset, you have unlimited profit potential, but you also have unlimited loss potential. Options don't have more loss potential unless you're trading more of them. If you're not using leverage, options have the same risk on the downside or less risk if you buy options. If you simply buy an option, then the most you can lose is what you paid for the option. So options are less risky. If you short an option, sure, you can lose money, but you're still ahead of the guy who went short the market because you're earning premium when they sell this option, right? You're getting paid. So you're still going to outperform the guy, the neighbor, who went short and was wrong. You sold calls and were wrong, but you're getting paid for it at least. You're the insurance company. Okay. The driver you insured had an accident. The philosophy of this risk manager is, I'm going to be the insurance company. I don't want to insure one driver. I want to insure a whole bunch of drivers so that my risk is diversified. And that's smart. More questions. Indices and stocks, as I mentioned, we do plan on having options on indices very soon, so please stay tuned. I think I need to end the webinar because it's getting close to 45 minutes. This is being recorded. We're going to clean it up just a little bit and it'll be published. Please open an account, use the WebTrader. To use the WebTrader, you just log into your account at the AvaTrade website and then click where it says web trading. Or you can go straight to the URL avaoptions.com and log in with your account number and password. You can also log into the WebTrader, which has the same look and feel with some additional features like auto chartist, but otherwise it's the same platform, excellent look and feel. And we have our legacy Windows platform, which I would say is for the more advanced users who are looking, who just want to see numbers and don't want to see all these charts. But the whole idea behind these charts is to give you a visual, interactive way of playing with your strikes, changing your expirations, and really understanding what you're looking at and getting that feedback from the interface to understand what you're trading. Thanks everyone for joining us. We look forward to seeing you on another webinar. Please do use the application. We have a chat box right here. You can come in and ask us questions in chat anytime, and we'll be happy to answer your questions. Good luck, trade safely, and have a great day. Stay safe. Bye, everybody. Thank you.